Better System Trader, Episode 9.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast, Episode 9. Today's guest has over 35 years experience as an investment professional focusing on underexploited investment opportunities. His award-winning research on momentum investing combines relative strength price momentum with trend-following absolute momentum. He is recognized as a foremost authority on the practical applications of momentum investing and serves as a consultant and public speaker on asset allocation, portfolio construction, and advanced momentum strategies. In today's chat, we discuss all things momentum, the different types of momentum, their individual applications, how they can be combined and refined, the benefits and challenges of momentum, plus why momentum works, and much more. So let's get right into it. Today's guest is Gary Antonacci. Hope you enjoy it. Gary Antonacci, thanks for joining us today.
My pleasure.
If we could just start with a little bit of your background into the investing or trading field, please.
I started out as a stockbroker back in the 1970s with Merrill Lynch and then Smith Barney, and decided after a bit that I wanted to be a money manager. So I went on to the Harvard Business School and got my MBA degree, started managing money privately on the side, and never had to go get a job after that. I've always been a private money manager, a consultant, a researcher, and most lately a writer.
Okay, great. So before we actually get into the details of your book, perhaps if we could just start with a story that is actually at the beginning of your book. It's a story about a person called D. I found it was quite interesting because it provided you with some life-changing insights which kind of steered you into a different direction. So for those that haven't read the book yet, do you mind sharing a little bit about that story and the insights you gained from what she'd accomplished?
Yes, I'd be happy to. When I was at Smith Barney, they had just taken over Harris Upham, and as part of that deal, they received one of the best over-the-counter traders in the business named Bob Topol. And he was an incredible market maker. So he would come around to the various Smith Barney offices and explain what he did and introduce himself. So after he gave us his presentation, we were all very impressed with it. And we were just sitting around afterwards, and he said, matter-of-factly, "Would you like to hear about the very best trader investor that I know of?" And we thought, well, great, let's hear about it. So we all sat back down and gave him our full attention. And he said, "The best, most successful investor I know of is my wife, Dee. Would you like to hear what she does or how she's done it?" And we of course, we're anxious to hear what that was, because here he was dealing with some of the top traders in the world, and he's telling us now that his wife was better than everyone. So he starts explaining that his wife has always been very patriotic. So long ago, she bought all the companies she could think of that had the words United States or American in their names. So she had American Motors, American Telephone Telegraph, U.S. Steel, and he just went on and gave us a very long list. And we didn't know if he was serious or not, but he seemed sincere. And then not long after that, he said, well, she did so well over the years. She was a fan of General Eisenhower and General MacArthur, so she bought all the generals too, General Electric, General Dynamics, General Telephone. And everybody had a good laugh and went out to lunch. But I couldn't help thinking about it afterwards, wondering what made her so successful. Now, this was before there was anything like an index fund. Nobody had any idea what those were, except a few people, in academia. Uh, so I just started thinking on my own, well, why was she so successful? And the reasons I came up with were, first of all, she had no transaction costs other than from her initial purchase of stocks. Secondly, there were no management fees. Uh, Thirdly, she had a well diversified portfolio. Most people had certain biases to their portfolios, whether it be glamour stocks or defensive stocks. She didn't have any of that. And fourthly, she wasn't hampered by behavioral biases, which caused people to buy and sell at the wrong times. She just bought things based on the letters of the alphabet and held them forever. So after thinking about that a while, I started thinking, well, do I really want to be in the brokerage business anymore? And that led me to reassess what I was doing, and I decided to move on.
You've published some research papers into momentum. How did you get into momentum from Dee's story?
Well, I was managing money in stock options for a few years, working with market makers on the various exchange floors. Uh, did well, and then that became more efficient. So I started managing hedge funds made up of commodity traders. I'd use portfolio theory optimization to put together groups of the very best traders in the world, like Paul Tudor Jones, Richard Dennis, Louis Bacon, and I did very well. So over a 10-year period or so, my investors were earning over 20% a year consistently with no losing years. And I was able to semi-retire after that. And I did some other things, which you can read a little bit about in the preface to my book. Uh, but about well, actually 6 or 7 years ago, I stumbled across some of the research papers on momentum. And I was familiar with momentum because I had read about it back in the 1970s. There was Bob Levy's book on relative strength, and I was intrigued by something like that. So it resonated to me, and I looked at all the body of research that had been done since the early 90s in momentum, and I thought, this is a true anomaly that can be and should be exploited. And I saw that people were not exploiting it in a way that made the most sense. Whatever was being done with momentum was being done on an individual stock level. And momentum was only good in certain ways. In other words, it would give you enhanced returns, but it did very little or nothing to reduce downside volatility or tail risk. So I gave it some more thought, and I figured that by combining things other than just stocks into a momentum portfolio, things such as fixed income and other diversifying assets, you'd be able to get out of equities at the appropriate time when the relative strength in these other assets was better. And so I did some research on it, and I wrote a couple of research papers. The first one was the second place winner of the Wagner Award in 2011, given by the National Association of Active Investment Managers. And then my next paper on dual momentum was the first place winner in 2012. And it laid out a basic methodology of using relative strength and absolute momentum, which is trend following, in order to enhance return and mitigate downside volatility.
That leads nicely into your book you've released recently called Dual Momentum Investing. It's won a few awards. It's a fantastic book. Could you tell us a little bit more about this concept of dual momentum?
Well, momentum is used in a lot of different ways, and it has a lot of different applications. But what I wanted to do was keep things as simple as possible, because the biggest danger when you're getting into rules-based trading or systematic type trading is overfitting models to your data and over-optimizing. So what I wanted to do was get something that people could use that was as simple and straightforward as possible. And for that, I did some additional research, things like Stocks for the Long Run by Jeremy Siegel points you in the direction of equities as offering the best risk premium, the highest return over long periods of time. So I figured whatever I came up with, I wanted to have it anchored in equities. And in order to get the benefits of diversification, relative strength, application of momentum with equities, you have to have more than just one kind. So the natural split to me seemed to be US equities, which has offered the very best returns historically, and then the rest of the world, the all world without US equities. So I figured that would be the basis of any investment approach that I had. That would take care of relative strength, momentum, to enhance returns. Now, in terms of reducing tail risk and volatility, I needed to have a different way of doing that, and that's looking at absolute momentum, which relative momentum is comparing one asset to another and going with whichever is stronger. Absolute momentum is looking at an asset compared to its own past performance. They're both trend following in the sense that relative momentum is looking at trends of one asset versus another, whereas absolute momentum is looking at the trend of the asset itself over time. So typically 1 year is a look back period that a lot of researchers use, and that has been shown to hold up well out of sample and in sample. So just for the sake of simplicity, let's say we're comparing US stocks to non-US stocks over the past year, and we pick whichever of those is stronger, and that will be our investment choice. Let's say it's US stocks. What we also look at is what has been the trend of US stocks over the past year. Has it been up or has it been down relative to a benchmark like Treasury bills? If it's been up, that means absolute momentum is positive, and we can feel confident that the trend should continue into the future. So we can go ahead and buy US stocks and continue to hold them as long as the trend over the past 12 months has been positive. Once the trend is no longer positive, then we step aside and we exit into something of a more conservative nature. In my book, I use aggregate bonds as a safe harbor in times when we're not in equities. So in my book, I lay out the background and the case for momentum investing. I give some of the reasons why it works. Although nobody's quite sure what they all are, I give a range of explanations for it. I give alternative types of investing that one might consider, and I show how momentum has advantages over these. And then I analyze the various assets and asset classes that one can use within a momentum framework. And I put that all together into a model I call the Global Equity Momentum, or GEM model. And that's offered to the readers of my book with a way that they can go and implement it themselves. It takes less than 5 minutes a month to do so.
So just to get a bit of context around this concept, what type of performance improvements do we see with the GEM model over, an index performance?
I go back 40 years in my book because that's as far back as I can get fixed income data. And the return from this type of model, average annual return, is in excess of 17% per year. That's not to say it will continue into the future, but that's what it has been in the past. And you can compare that to the S&P 500, which has probably had a total return of around 10% a year over that time period.
So that's quite a substantial difference over the long term, isn't it?
Yes, it is.
So you mentioned look back. So I think you said that look back preferred amount is 12 months or 252 days. What's the impact of changing that length of look back?
Oh, that's a very good question. Momentum is very robust, and what I show in my book is that you can use various lookbacks and they work successfully. That's one of the things you look at when you're doing systematic trading. You want to make sure your parameters hold up over a range of values. You also want to make sure that your approach applies to different markets. Uh, and I do that. And then you want to look at consistency. So I look at every 10-year period and I show how consistent it is. And I show various look-back periods, how they work. Academic research has shown that anywhere from 3 to 12 months works very well as a look-back period. There's a trade-off there. You'll be more sensitive by using shorter look-back periods. In other words, you'll get out a little closer to the top. We're speaking absolute momentum here, which is the trend following component. And you'll get in a little sooner when the markets make their bottoms. But the trade-off there is that you'll have some whipsaws where you'll get in and out inappropriately. So the longer term windows like 10 or 12 months minimize those whipsaws considerably, and they get you in and out a little bit slower at tops and bottoms. But that doesn't matter too much because the advantage of getting in and out at all is that you minimize your downside volatility considerably. Instead of having maximum drawdowns in excess of 50%, the dual momentum approach has maximum drawdowns on the order of, say, 20% on a month-end basis. So there's a considerable reduction in downside volatility. And if you can stand aside when other people are losing money and then get back in not too long after the trend starts asserting itself, you're picking it up at a higher level than other people are. And that's why over time, this approach has a substantially higher return. Some of it comes from relative strength by being in the strongest asset at the right time. But a large component of that excess return, that abnormal return, comes from the timing aspect of being able to avoid the bear market equity erosion and having to make that up before you can proceed. We don't have to make that up. So when the markets get going again to the upside, we just pick up where we left off before.
Oh, that's really interesting to hear that the majority of the performance is coming through through the market timing of getting out or changing instruments in a bear market.
Well, I don't want to say all of it or even most of it because relative strength does play a significant role. And some people have mischaracterized dual momentum as just market timing. That's not what it is. Relative strength is also very important, but relative strength by itself is subject to extreme volatility at times, just like the market itself. And that's why the dual momentum, I think, makes so much sense.
So you talked about getting in and out at tops and bottoms. Being a long-term trend following approach, how does dual momentum respond during times of short-term market corrections?
Well, you'll suffer through those. There's no getting around it. You can't have everything. And if you had, what would you do with it? So that's one of the things people have to realize is that if you're going to be in equities alone and only worry about getting out when there are longer term bear markets, you're going to have to be prepared for some short-term volatility. Now, the fact that you can feel like dual momentum has a good chance of saving you from those really severe equity erosions during bear markets may give you more confidence to suffer through the slings and arrows of some of the short-term volatility.
So how often would you reposition a strategy like this?
I rebalance on a monthly basis. The profits are enhanced by doing it on a monthly basis. Some people use momentum and rebalance quarterly or even semi-annually, but there's a trade-off there. Monthly, I think does an excellent job. It's not too long and not too short. If you go any shorter than a month, then you get into some mean reversion going on where you may react when it's better that you didn't. That's what I'm talking about, just allowing for some of that short-term volatility to occur, so that you don't get whipsawed.
Okay, that's interesting actually. But when you're looking at momentum, do you take into account the volatility of the move? For example, you just mentioned mean reversion. So if you're using stocks and you've had a stock that has had a very large move recently, I guess you would expect the stock to mean revert over the short term. How do you account for that?
Well, when you're dealing with stocks, the typical procedure is to skip the last month so you don't get caught up in that mean reversion on a short-term basis. Um, I don't deal with individual stocks. I deal with broader asset classes where that's not such of a big problem. So, and because we have a 12-month window, uh, we're not subject to short-term volatility affecting our decisions on what to do as much as if we had a shorter window.
Okay, so let's have a bit of a chat about alternate asset classes. So you mentioned, I think in the GEM model, switching to bonds. Can you use other instruments, for instance, short ETFs?
You can, but because of the lags, because I have a slower moving approach, uh, and the market has a tendency to go up over time, by the time you go short and then get out of your short, uh, you're not making that much on the short side. You're better off just being in bonds during that period, because what happens is that when you do get a signal from absolute momentum that stocks are topping out, it usually indicates there's a recession coming. And during recessions, that's when interest rates tend to stay low, typically, not always, but generally that's the best time to be in bonds. So we're in stocks at the best time and we're in bonds at the best time. And we can do well when we're not in stocks just by being in those bonds at the best time to be in bonds.
So you mentioned earlier in our chat some reasons why you think momentum does work. Can you share some of those with us?
Well, the primary reasons are behavioral. You've got some different factors that cause people to underreact and overreact to information. So initially, if we're speaking about stocks, for example, initially stocks will underreact to news that comes out. So there's an inertia effect that takes place there. And then later on, there's a catch up that takes place or a bandwagon effect. So that causes stocks to trend and to perhaps overshoot what might be fair value. Then there's also the disposition effect, where people will sell their winners too soon and hold on to their losers too long. So these are all things that can cause momentum to work, and they're embedded in our DNA. You know, things like herding. Uh, you find that all throughout nature, and it doesn't go away. So that gives us confidence that momentum should continue to work into the future because human nature is not, such as it is not going to change. And in fact, by utilizing momentum, we can harness that in our favor instead of being subject to it in negative ways.
So what are the challenges then of using a strategy such as this?
The biggest challenge is to stick with it. Sometimes you may want to do something that's counter to a rules-based approach. So that's another reason why I wrote my book, to give people the background information and the resources and the links they can go to satisfy themselves that momentum works. There's been a tremendous body of research over the past 20 years on, especially on relative momentum, but recently also on absolute momentum. So if people can become aware of it and look and see that this has gone back 200 years in backtesting of relative strength momentum, and now 800 years in absolute momentum. And it's held up over all that time, over all different kinds of markets. And if they can have confidence in it, then that can allow them to stay with a rules-based approach without being shaken out of it during periods of short-term volatility or when some other new idea comes along or when they just don't feel good about the markets. So that's the biggest challenge. The next biggest challenge would probably be uh, to not mess around with something that works. I get emails all the time from people saying, well, how about if I do this? And how about if I do that? And I say, well, it's a free country, but if I were going to do it, I would want to make sure that it passes a number of tests. Does it make sense? Uh, does it apply to different markets? Does it hold up consistently over time? Do the parameters hold up over a range? Uh, I'd want to satisfy myself and be very careful and have a lot of data to back it up. Uh, Danger that many people I've been seeing out on the internet, uh, danger they get into is to just take a limited amount of data and play around with it a little bit, overfit your data, and think you have something better. I think you may be fooling yourself.
Your book shows results up to the end of 2013. How have your models performed since then?
You can go to my website and see. I They've done well. I have a number of different models. I have 5 different models now. So I have one for uh, the global equity momentum. I have a uh, socially responsible investing model. I have a dual momentum fixed income model, and I have a dual momentum sector rotation model. So you can go onto my website. I have a performance page that updates all of these on a monthly basis.
It's interesting to hear that you have a number of applications for this concept. Which do you think works best?
They all work. Uh, it's kind of like, which of your children do you like the best? It's it's really what suits you the best. I think simplicity has an advantage over complexity. So that's why my book is oriented towards the global equities momentum model, which is very simple and easy to implement. Uh, Dual momentum fixed income is also simple. The socially responsible investing model is the same one that I use for global equities momentum. So if people, are oriented towards environmental, social, and governance issues, that would be a great model for them to follow. If they want to just be something they're familiar with, like the S&P 500 or aggregate bonds and non-U.S. stocks, then that's a good model.
Okay, and a final question. If you had to choose between relative or absolute momentum, which one would it be and why?
If I had to choose, I would choose absolute momentum because both of them enhance return, but only absolute momentum will mitigate the downside and considerably reduce your downside volatility. However, what's important to realize is you don't have to choose between the two. You can select both. And that's what dual momentum is all about. That's why I have uh, a website devoted to it, a blog called Dual Momentum, and my book is called Dual Momentum Investing.
Excellent. Thanks, Gary. So if we can just finish up now with some closing questions. What's the biggest lesson you've learned through investing or trading?
The biggest lesson I've learned is to stay with whatever approach that I have, to investigate carefully, choose wisely, and follow faithfully. Uh, that's basically it.
What's the best trading advice you have ever received?
Oh, it's probably something along the lines of the trend is your friend, cut your losses, let your winners run, that kind of thing, to
Mm.
realize that I know that, market timing is sometimes looked down upon, but uh, I think it can be done. It can be done successfully. And working with commodity pool operators for many years, I saw that it can be done very successfully. You just have to have the research behind it and the discipline to stick to it.
Okay, thanks. Can you share one of your personal habits that you strongly believe contributes to your success?
I try to lead a balanced life. So that I don't get so caught up in the craziness that's all around me, including craziness that you see in the markets. I stay away from the news. Um, I follow what's going on more from a research point of view.
Do you have a favorite website or resource that you follow?
Well, I use the Social Science Research Network, SSRN, a lot to
Yep.
uncover new research and new working papers that have come out that have all kinds of interesting ideas in them. I also use Morningstar as part of my research. I follow a few sites like Quantocracy and Abnormal Returns to keep me up on some of the interesting things that are going on in the investment world. And I also can recommend that people go onto Twitter and find some people who invest in a way that is like-minded to you, and connect to them in Twitter. You can connect to me in Twitter. And I repost a lot of things that I find interesting.
Okay, thanks. That's a lot of great resources there. And do you have a favorite trading book or books?
There's a number of them. Besides Stocks for the Long Run by Jeremy Siegel, I think that's a good book to convince people that equities is where you want to be for the long run. But I think behavioral finance and the psychology of investing are important. So any books written by people who specialize in that would be useful and worthwhile.
Okay, thanks, Gary. And finally, what's the best way for listeners to get in touch with you?
My website, Optimal Momentum, and my blog, Dual Momentum, have contact pages, so they can send emails to me that way. And I'm happy to respond to any emails that I receive.
Okay, excellent. So thanks so much for sharing with us today, Gary. Is there anything else that you'd like to mention before we wrap up?
I encourage people to look into momentum, to not be swayed by any prejudices or things they may have heard, but to keep an open mind and to investigate. And then you may be surprised at what it can do for you.
Thanks, Gary. So I highly recommend everyone go and check out Gary's website and his book, Dual Momentum Investing. I'll add links to the website and the book in the show notes for everyone to be able to find it easily. Thanks again for your time today, Gary. I appreciate it.
My pleasure. Thank you, Andrew.
Fantastic chat with Gary today. I really enjoyed learning about the different types of momentum and their uses. Relative strength is used to get you into the strongest instruments, while absolute momentum is used to protect you, reducing downside volatility and protecting you in a bear market. I was also interested to hear that a large component of the excess return in dual momentum actually comes from avoiding the bear market equity erosion. So it definitely helps to be defensive when market conditions are far from optimal for your strategy. The other takeaway for me was keep it simple. The dual momentum strategy only has a few simple rules, but Gary's research has found that over 40 years the model averaged an annual return in excess of 17% per year, so simple obviously works. Now for the bonus this week, Gary has kindly offered a signed copy of his award-winning book, Dual Momentum Investing, for one lucky listener. All you have to do to enter the draw is go to the show notes page for this episode, click the link to enter and submit your email address so we can notify you if you've won. So it's pretty simple to enter. The draw will be open until next Sunday, which will be the 7th of June. Gary will choose a winner from the email submitted and we'll let you know if you're the lucky winner or not. So good luck to all those who enter. By the way, the show notes for episode 9 can be accessed directly by going to bettersystemtrader.com/9. Anyway, that's it for this week. I hope you enjoyed the chat with Gary Antonacci. Thanks for listening to Better System Trader and catch you next week. Bye.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.